A few months ago, I opened my banking app to check something routine. Just a quick balance check before heading out the door. But before the dashboard loaded, a little message popped up on the screen. Help us serve you better. Please update your annual income. Nothing dramatic. Just a small blue button underneath that said Update Now. So I paused for a second and thought about it. My income had changed since the last time I opened the account years ago. A raise here. A promotion there. Updating it seemed reasonable, almost responsible. Like keeping your address current with the post office. But then something odd occurred to me. Why does the bank want this number so badly? Not when I apply for a loan. Not when I request credit. Just randomly. In the middle of a Tuesday morning balance check. And that's when I started digging. Because that tiny little question, the one that looks like harmless account housekeeping, might actually be one of the most profitable questions a bank can ask you. And most people answer it without thinking twice. Hey, I'm Brian, and I spend way too much time thinking about how financial institutions design systems around our behavior. Not just what they say they're doing, but what's actually happening behind the scenes. And here's what most people don't realize. Banks are masters of something I call frictionless data collection. They don't demand information aggressively. They don't make it feel like paperwork. Instead, they ask for it casually, politely, in moments where it feels routine. Update your phone number. Confirm your address. Tell us your income so we can serve you better. But when you step back and look at it objectively, something interesting appears. In many everyday banking situations, they don't actually need that number at all. Yet they ask for it constantly. Why? Because income is one of the most powerful predictive signals in consumer finance. It tells algorithms how much you can borrow, how likely you are to spend, and, maybe most importantly, how profitable you might be over the next 10 or 20 years. In other words, when you tell a bank your income, you're not just filling in a profile field. You're feeding a model. And here's what happened behind the scenes when I started looking into how those models actually use that number. It turns out your income can quietly influence everything from your credit limits to the kinds of offers that start showing up in your mailbox. Sometimes in ways that benefit you, but very often in ways that benefit them a lot more. Now, before we get into how this works, if you enjoy content that breaks down financial systems like this, not hype, not conspiracy, just clear explanations of how the mechanics actually work, consider subscribing. Think of it as peer review for ideas like this. Because the goal here isn't to make you angry at banks. The goal is to make you aware of how the system works, so you can decide what information you actually want to give it. So let's start with the first way income data quietly changes how banks interact with you. Credit limits. On the surface, this looks like a reward. You update your income, and suddenly your credit limit jumps. Maybe from $5,000 to $12,000. Or from $10,000 to $25,000. It feels like recognition. Like the bank is saying, we trust you more now. But here's what most people don't realize. Higher credit limits aren't primarily about rewarding responsible customers. They're about increasing spending capacity. In banking circles, there's a simple equation that drives a lot of these decisions. Available credit influences actual spending behavior. When someone's credit limit increases, their average balance tends to increase too. Not always intentionally. Sometimes it's just psychological. A $2,000 purchase feels very different when your limit is $3,000 versus when your limit is $20,000. One feels risky. The other feels manageable. Banks know this. In fact, internal risk models often estimate something called utilization elasticity, basically predicting how much a customer's balance will grow when their available credit grows. So when you update your income and the system suddenly thinks you earn $120,000 instead of $65,000, something interesting happens. The algorithm recalculates your potential borrowing capacity, not just based on your past behavior, but based on what someone with your income level statistically does. And those models can be surprisingly specific. A consumer earning $50,000 with a $6,000 limit might carry an average balance of $1,200. Increase the limit to $18,000, and the expected balance might jump to $3,500, which means more interest payments, more interchange revenue every time the card is swiped, more long-term profitability. Now, to be clear, Higher limits can actually be useful for responsible users. They can improve your credit utilization ratio and sometimes boost your credit score. But the intent from the bank's perspective is different. The limit increase isn't primarily about helping you manage credit better. It's about expanding the ceiling of possible spending. And what triggered that ceiling adjustment in the first place? That one little number you volunteered. Your income. Which raises an interesting question. If that single piece of information can change your borrowing capacity overnight, what else does it change behind the scenes? Because the next mechanism is even more surprising, and it has to do with something called ability to pay pricing. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Now, when most people think about interest rates, they assume the pricing is purely based on risk. Your credit score, your payment history, your debt levels. And yes, those factors matter. But in many parts of consumer finance, pricing models also consider something else. How sensitive you are to the price itself. In other words, how likely you are to negotiate or walk away. And this has a name in banking and economics circles. It's called ability to pay pricing. Here's how it works. Imagine two customers with identical credit scores, say 740. Same payment history, same debt levels, same credit utilization. But one reports an income of $45,000. The other reports $150,000. From a pure risk standpoint, they look almost identical. But from a profitability standpoint, the models often make a subtle assumption. Higher earners are statistically less price sensitive. They're less likely to call and argue over a 1% interest difference, less likely to shop aggressively between lenders, less likely to restructure their financial products over small pricing gaps. So instead of competing aggressively for those customers, institutions sometimes price products slightly higher because the model predicts the customer will accept it. And this doesn't always show up in obvious ways like a dramatically higher APR. Sometimes it appears in things like slightly higher loan margins, fewer promotional balance transfer offers, less aggressive refinancing incentives, tiny differences that most people never question. But across millions of customers, those small differences add up to enormous revenue. And again, what powers those predictions? Data. Specifically, signals that help banks estimate not just whether you can pay, but how likely you are to care about the price. Income is one of the strongest signals in that entire system, which leads to the third mechanism, and this one is probably the most visible. Because once your income band changes, the kinds of financial products you're offered can change almost overnight. Once your income enters the system, it doesn't just sit there quietly in a profile field. It gets used to place you into something banks call a customer segment. Every large financial institution divides its customers into income bands. Sometimes it's simple brackets like under $50,000, $50,000 to $100,000, $100,000 to $250,000, and so on. Other times it's more granular, combined with spending behavior, credit score, and location. Why? Because different income segments respond to completely different financial products. Someone earning $40,000 might receive offers for balance transfer cards, lower fee accounts, or short-term credit products. But someone the system believes earns $150,000? The marketing changes almost immediately. Suddenly, you start seeing invitations for premium travel cards, concierge services, personal credit lines, high-limit cards with annual fees that can run $400, $600, sometimes even $700. On the surface, it looks flattering. It feels like the bank is welcoming you into a more exclusive tier. But remember the economic logic behind it. Higher-income customers typically spend more per transaction. They travel more. They use rewards programs more heavily, which means every swipe generates higher interchange revenue for the bank. And those premium cards with large annual fees? Those are extremely profitable products. So when you update your income, what you're really doing is signaling something to the bank's marketing systems. You're telling them what category of customer you belong to. And once that classification changes, the system starts delivering products designed for people in that income bracket. Sometimes those products are genuinely useful. but sometimes they're simply more expensive. Which raises another question. If your income affects what the bank offers you today, what happens to that information 5 years from now? Because the final mechanism is the one most people never think about, and it's the one that lasts the longest. When you tell a bank your income, you might think you're answering a simple, temporary question. But internally, that number often becomes part of your long-term customer profile. Banks track something called lifetime customer value, an estimate of how profitable a client might be over the span of an entire banking relationship. 10 years, 20 years, sometimes longer. To calculate that number, they feed models with dozens of variables: credit behavior, spending patterns, product usage, and yes, income history. Because income isn't just a snapshot of today. To the models, it's a signal about future potential. If someone reports $90,000 today, the system might project that they'll earn $120,000 within 5 years based on career patterns and demographic trends. That projection then influences all kinds of decisions you never see directly. Which customers get retention offers? Which customers receive special financing promotions? Which customers are prioritized for wealth management services? In other words, the number you type into a simple "update your income" box today can quietly shape how the bank treats you years into the future. And most people never even realize that profile exists. They assume they're just interacting with a checking account or a credit card. But behind the scenes, the institution is building something much more detailed: a long-term financial portrait of you. And once that portrait is created, it starts influencing decisions automatically. Which is why a conversation I had with a friend last year suddenly made a lot more sense. Because she experienced exactly what happens when your income data suddenly changes inside that system. Which brings me to a conversation I had with a friend of mine last year. We'll call her Sarah. Sarah had been using the same bank for almost a decade. Pretty quiet relationship. One checking account, one credit card, automatic bill payments, nothing complicated. She wasn't the type constantly chasing financial products. She just wanted her bank to work. Then she got a promotion at work. Her salary jumped from about $62,000 to just under $95,000. Naturally, when her banking app prompted her to update your income to help us serve you better, she figured it made sense. Took maybe 30 seconds. Typed in the new number. Hit save. And at first, nothing happened. Then about 2 weeks later, things started changing. Her credit card limit increased from $8,000 to $20,000 without her asking. A few days after that, she got an email offering a premium travel rewards card with a $550 annual fee. Then came the personal loan offers. Pre-approved. Exclusive rate. You've been selected. Then investment services invitations. Then balance transfer promotions. Within about a month, the quiet, boring relationship she'd had with her bank for years suddenly turned into a steady stream of financial offers. Now none of those offers were illegal. Some of them weren't even bad. But what caught her attention was the timing. For nearly 10 years, the bank treated her like a low-maintenance customer. Then one number in her profile changed, and suddenly the system saw her differently. Different income bracket, different marketing category, different expected profitability. And once she realized that, she started asking a simple question most people never think to ask. Which of the information my bank asks for do they actually need? And which parts am I just volunteering? This is the point where it's important to slow down and separate two things that often get blurred together: what banks can ask for and what they legally require. Because those are not always the same. When you apply for certain types of credit, like a mortgage, an auto loan, or a large personal loan, income verification is absolutely standard. Lenders have to evaluate whether you have the ability to repay the debt. That's a legitimate part of the underwriting process, and in many cases documentation is required. In those situations, income disclosure isn't optional. It's part of the application itself. But outside of those contexts, many of the income update prompts people see are simply requests for additional data, not legal requirements. When your credit card app says, "Update your income to improve your experience," that's usually about improving the bank's models, not fulfilling a regulatory obligation. And to be very clear here, the point is never to lie or misrepresent information. Providing false financial information on an application can create serious problems. That's not what this conversation is about. The point is something much simpler. You are not obligated to volunteer every piece of financial information an institution asks for when it isn't required. There's a difference between honesty and over-disclosure. And once you understand how valuable certain data points are to financial institutions, it becomes easier to decide when sharing that information actually benefits you and when it mostly benefits them. So if that's how the system works, the natural question becomes practical. What do you actually do with that information? The first scenario is new credit applications. If you're applying for something like a credit card, lenders typically ask for income because they need to estimate your repayment capacity. In that case, provide accurate information. The goal here is never to hide facts during an underwriting decision. But notice something important. Once the account is open, the bank will often continue asking you to update that number over time. Those later updates are usually optional. The second scenario is those random update requests that pop up in banking apps. Confirm your details. Update your income. If nothing about your banking relationship has changed, you're not applying for new credit, you're not requesting a higher limit. There's usually no practical reason you must update it immediately. Your payment history already tells the bank the most important thing, whether you handle credit responsibly. The third scenario involves credit limit increases. Sometimes banks tie those offers to income updates. But remember what we talked about earlier. A higher limit isn't automatically a financial upgrade. If you want the additional flexibility and you manage credit carefully, it can be useful. If you don't actually need more borrowing capacity, it's perfectly reasonable to leave things as they are. Fourth scenario, loan applications. When you're applying for something substantial, a mortgage, a car loan, a refinance, transparency matters. Lenders need a realistic view of your financial position. Those are situations where accurate disclosure works in your favor because it allows the lender to evaluate the risk properly. And the final scenario is something more subtle, data minimization. Financial institutions already learn an enormous amount about you through behavior. Every payment you make on time, every balance you carry, every purchase pattern on your card. That behavioral history is often far more meaningful than any single number you type into a form. So sometimes the smartest strategy is simply letting your financial behavior speak for itself. Because responsible habits create a record that's far more reliable than self-reported information. And unlike income updates, that kind of data can't be volunteered on command. It has to be earned over time. When you zoom out, this conversation isn't really about one question inside a banking app. It's about how modern financial systems run on information. Banks, lenders, and credit networks operate on massive data models designed to predict behavior. The more signals those models receive, the more accurately they can estimate what kind of customer you might be, how much you'll borrow, how much you'll spend, and how profitable that relationship might become over time. That doesn't make the system evil, but it does create something economists call information asymmetry. They know far more about how the system works than most customers do. And once you recognize that imbalance, something interesting happens. You realize that financial power isn't just about earning more money. It's also about understanding when to share information and when to let your actions speak instead. Because banks can ask for your income anytime they want. They can prompt you with update requests. They can nudge you with friendly little notifications. But there are things they can't ask for in a pop-up box. They can't request 10 years of discipline. They can't request consistent payments. They can't request restraint. Those things show up naturally in your financial behavior. And in the long run, that record will always say more about you than a single number ever could.